Federal Reserve Chair Jerome Powell told the Senate Banking Committee Tuesday that the Fed could raise rates higher and faster than planned. While prices have gone down since the Fed first started hiking rates, the central bank has yet to reach its target.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Powell said the process of getting inflation down to the Fed's goal of 2% has a long way to go and is likely going to be, quote, bumpy. The markets reacted Tuesday. The Dow closed down more than 570 points, and the NASDAQ 145 points in the red. Jeanna Smialek joins me now. She's a Federal Reserve and economy reporter at the New York Times. She also just came out with a book titled Limitless: The Federal Reserve Takes on a New Age of Crisis and Unpredictability. It's so good to have you here. Thank you for being here, and congratulations on the book. What did you make of what Chairman Powell said today?
This was a newsy day, no question about it. Much newsier than I think I expected, much newsier than any of the economists I follow expected. He was very clear that it is likely that interest rates are going to rise further than economists and Fed officials had previously expected. And he also really walked onto the table the possibility that the Fed could raise interest rates by half a point in their upcoming meeting on March 22nd, which is quite a bit larger than the move we just saw in February, and would be a real sort of shift in strategy from what the Fed's been doing over the last couple of months.
So the Fed has been, some people would say, caught sleeping originally. You put this in context, but let me get the question out first, which is they have had trouble anticipating where things are going. Do you see what was surprising today in that same context, or was this always a part of the gentle tweaks that the Fed always must do?
No, I think the Fed has been very surprised in the last couple of months. They thought that they raised interest rates a lot last year, fastest pace of interest rate increases since the 1980s. And they very much thought that they had gotten them to a level where they should be really starting to weigh down the economy. And that seemed to be playing out at the end of 2022. The economy was slowing down, inflation was moderating, and then we just got some whopper data reports in January and February of 2023. And so I think now they're starting to really question whether they actually have rates at a level that is sufficiently high to constrain an economy with this much momentum.
So the economy is too strong. And that when he talks about bumpy, how do you read that? Because it sounds to me like there's going to be more unemployment than even they expected. And that bumpy means real people, real lives, not having jobs. That's scary for people who are worried about their economic stability.
Bumpy seems like bad news. I think if I had to guess, and we didn't get a ton of clarity on what he meant from that today, but if I had to guess, I would bet that he was trying to send a signal that this sort of benign outcome, this magical soft landing situation that we've all been talking so much about, while still a possibility, is not sort of the base case. It's not the most likely outcome. It's likely that unemployment's going to rise a little bit. It's likely that there's going to be some cooling in the labor market because we're just not seeing enough of a deceleration without it.
Right. So instead of soft landing, it's brace for impact. Let me ask you about the original reason we were going to talk today, which is that you co-authored a piece in which you wrote about premiumization. Tell us what that is.
Premiumization is pretty logical to anybody who's ever flown on an airplane. It's this idea that you segment your customers into different groups: premium, so first class, and economy, the sort of lower tier customers. The interesting thing that's happening in the economy today, though, is we're seeing it across a whole range of products and industries. It's not just the airlines anymore. So, you have seen it pop up in just dozens of earnings calls this earnings season, for everything from Krispy Kreme donuts to Six Flags amusement parks.
So what they're doing is they're basically taking people with a lot of disposable income and saying, you thought you liked donuts, let's give you a special fancy donut and charge you more for it. Is that essentially what's happening?
Absolutely. So we see these companies really sort of trying to give a better option, quote unquote, better option of whatever it is that they offer to sort of capture a customer who's maybe willing to spend a little bit more on that product. And the goal here is really to keep profit margins wide at a time when companies have enjoyed really wide profit margins for a while, and they're nervous that those are going to go away.
Is this meeting a market need? People are saying, I really want a more luxurious donut. Or are they basically creating a market for status-conscious, wealthy people?
I think it's probably some combination of the two. I think that it is clearly the case that we have seen strong demand for premium offerings in a range of industries. Automobiles is one that comes to mind. Cars have really been premiumizing. And so I think a lot of companies are looking at that and saying, why can't I do that too? And so there is some amount of demand going on here. I also think it is the case that people are trying to sort of migrate their customers towards these premium options. You might have come in for the dozen of discounted glazed donuts, but if I'm offering you these fancy holiday donuts, maybe you'll buy those instead.
Right. Solutions to cravings you didn't know you had. Okay, what about the rest of mankind? One of the things that was interesting in the piece was you talked about, like, cars, for example. Just the number of offerings for people under $25,000, I think it was, just a lot less. Is that connected to this?
Yeah, so standard economic theory would suggest that if you just don't offer anything to poor people, if you premiumize the entire market, then somebody else should come in and sort of compete for those market shares. But as we all know, things have been really messed up in the pandemic era. There are just shortages of things. And we are seeing situations in some markets, cars being the most important one, I think, where we're just not seeing anyone step in quickly enough to fulfill that need. And so we're just seeing sort of the bottom fall out of the market. You're seeing this shift up the income ladder. And I think that has really important implications for whether people at the lower income ranges actually get served by consumer products.
Right. And not to mention just the societal impacts of seeing everybody around you wearing, buying, and otherwise doing things that show that they're in a higher status place. I mean, what that does for society, we'll have you on to talk about another time. Jeanna Smialek, thank you so much for being with us.
Thank you.